Hello, everyone. This is part two where we dig into some of the expenses that go on Schedule C. Now, the expense we're talking about here is depreciation. This will also apply when we get to rentals. So we'll talk about it here in Chapter 6, but it also applies to Chapters 7 and 8 and 12 and some of the other that we talk about. So once we learn about depreciation, any time that we have an asset. Now, it does have to be used in a business or some type of a rental activity. Personal assets like our house or our personal vehicle we do not calculate depreciation on them or deduct the depreciation on them. It has to be, in this case, for this chapter, used in a business activity. So it has to meet the definition we talked about in part one of being a business, meaning it has to be engaged in for profit, and you have to actually use that asset. So this is about assets you buy that are going to last more than a year. Okay? And we're going to talk about how we calculate depreciation. We're going to talk about some bonus depreciation because they are always changing the rules with depreciation because the Congress believes that buying assets for a business is a big thing in the economy. And so they often want to stimulate businesses to buy more. And they believe that if they make those assets have a greater deduction for having the assets, that businesses are more likely to buy them. Okay? So they're always tinkering with the rules about depreciation. It's and making them different and so forth. So that's one of the reasons why that's such a complex situation. So we buy an asset and we need to calculate depreciation, so we need to know how, so we can deduct that depreciation as an expense on our Schedule C. We need to know the basis. Typically, almost every asset you have in the business is going to be, the basis is going to be the cost, what you paid for it. Okay, so $10,000, let's say. Okay, that's the basis. That's what we paid for the asset. Okay, then we look and see what depreciation time, over what time period. Now, in regular accounting, we allow basically to pick whatever time period matches the asset exactly. In tax depreciation, the IRS simplifies it by basically telling us it's got to be one of 3 or 4 asset class lives. So basically, they don't let us choose a lot of it. Basically say, this asset, we're going to assume it's going to last 5 years. And this type of asset, we're going to assume it lasts 7 years. Almost all the assets you come across in a business are going to be 5 or 7 year assets, meaning the IRS has decided that those are depreciated over 5 or 7 years. A few are 10, couple are 15, and then real estate, okay, is going to be much longer than that. Okay, and we'll talk about that specifics in a minute. Depreciation convention. Typically, we're going to be using the half-year convention. Half-year is built into the calculation. So the IRS not only determines what life you have to use, asset class life, they also give you tables to help you calculate the depreciation. And in those tables, the half-year convention is built in. For real estate, you have to use mid-month, and mid-quarter is only used when we buy more than 40% of our assets in the final quarter of the year. So if you remember from earlier accounting classes, half-year convention for depreciation basically says we assume all the assets were bought halfway through the year, so we don't have to figure out per month and all that kind of stuff. Okay, but that doesn't work well if you wait and buy all your assets at the end of the year. So the IRS built that into the law, that if that's the case, then you have to go to the mid-quarter convention. And then you have a method. Okay, double declining balance or straight line is essentially the two that are used for taxes. Okay. All right, a little bit about basis. We talked about it being cost. Now, special situation, especially with small businesses. Often they will start a business and they will convert personal assets to business assets. A computer that they have had for a couple of years is now used in the business. Okay, so what does that basis? What do you use to calculate depreciation? And the rule is, it is the lesser of the fair market value or cost. So if you bought a computer and you paid $1,000, and that's 2 years later, it's not worth $1,000. Let's say it's only worth $500. You can use that to calculate depreciation because it's lower than what you paid for it. Okay, you can't use fair market value or the value of it if it's higher than what you paid for it. But that hardly ever happens, okay? Same thing with cars or buildings or anything like that. The lower of the fair market value or what was originally paid when you convert it from personal to business. Remember, during the time it was a personal asset, no depreciation. Only when it's been converted and you start actually using it, okay? Now, you can have an asset that has both personal and business. Let's say you use it 50-50. You would depreciate just the business part. Okay, and so your basis would be the half that is actually used in the business. Okay, now if you got the asset as a non-taxable exchange, and we'll talk more about that in a different chapter, what that means, a non-taxable exchange. Okay, then the basis is going to be the cost less any deferred gain. That'll make more sense. Don't worry about that too much. Okay, inherited basis. If you inherit an asset you're going to use in the business, then it's the fair value at the date of the death of the person you're inheriting it from. Okay, into your business. So those are very rare, but often you are converting from personal to business. So that's our most important one there. Typically, the first two are going to be 98% of the situations that you're going to run across in a small business. Okay? Here is the IRS narrowing down your choices in terms of how long you're going to depreciate. So if it fits in the 3-year, you're going to take the cost and you're going to depreciate it over 3 years. Autos and trucks, computers obviously are very common. Okay, so that money assets are 5 years, and then all your furniture, all of your copiers, all the fixtures in your building, that's only 7 years. And then if it's residential real property, which is really for rentals, then it would be 27.5 years. And real estate that's commercial. So basically, if it's used in your Schedule C, it's commercial, non-residential, then it's 39 years. So you take the cost and depreciate it over 39 years. So really not too much of a choice. There are other periods, 10 years, 15, but again, they don't come up nearly as much. Okay, so half year in the year you buy it, a half year in the year you sell it. You get rid of it or stop using it, okay? Mid-quarter convention only if you buy more than 40% of the assets, and mid-month for all real estate. So 27.5-year property, 39-year property, mid-month. Now, what does that mid-month mean? Okay, half year assumes that all assets were bought halfway through the year, built into the tables that are shown in your textbook, so you don't have to turn around and multiply by half. Okay. Mid-month convention means if you bought it in January, doesn't matter whether you bought it on the 1st of January or the 31st of January, we will calculate depreciation from the 15th of January, the middle of the month. So if you buy an asset any time in January that's a real estate, you're going to depreciate it for 11.5 months because you're going to have it January, assume starts on January 15th, okay, to the end of the year. If you bought it in April, you're going to assume it was bought April 15th, whether you bought it April 1st, April 30th. So you're going to calculate depreciation for the April 15th through the end of the year. Okay, so that's 8.5 months. So it's always a half a month. So anytime you're calculating depreciation on real estate, if you don't have something in there as a half a month, then you, in the first year that you bought it, okay, now the second year, and the third year, and the fourth year, you don't have to worry about that half a month. But the first year and the year that you sell it, you have to do that, okay? All right, so your 5 and 7 year or 200 declining balance, we're just going to use the maker's tables that were shown in textbook, okay? 150% declining balance applies to 10 and 15-year property that, again, doesn't come up very often. All real estate is straight line, all right? So you don't have to worry about the formulas for double declining balance. You can use tables. There are some provided, but typically it's just as easy to calculate using the year, okay? And in the first year, you're going to have to do the half a month. And then every year after that, you just take and divide by 39 or 27.5 for real estate. And it's because it's straight line, you know that that formula is very simple, what we've learned about depreciation earlier. And all this is going into calculating a depreciation expense number that is one of the expenses on the Schedule C that we talked about earlier. Okay, and there's actually a form for calculating the depreciation, okay, that is shown in your textbook where you calculate all the different types of depreciation. All right. Now, some special rules. Again, Congress thinks that if they make their extra depreciation, then you might buy more assets and therefore have more economic activity and so forth. So the first one, the special, is called Section 179. You can probably guess where you could find that in the Internal Revenue Code, probably in Section 179. So us creative accountants decided to call it Section 179 depreciation. This is special, okay, depreciation where you can depreciate all of the cost of the asset. Now, even though it's going to last 5 years, you're going to depreciate it all in the year that you purchase it, okay? As long as it qualifies as Section 179 asset, and there are some limitations, okay, then you can depreciate 1,160,000, and so that's a lot of that you can purchase. So literally, if you spend on assets up to 1,160,000, you can deduct all of the cost of those assets as long as they fit the definition of a Section 179 asset, which is fairly broad. There are some things that don't work, like things you're going to rent out, that sort of thing. But often, most of the time, that is going to work for that. Now, if you spend more than 1,160,000, then the Section 179 doesn't apply. So for larger small businesses, because $1 million seems like a lot, but it doesn't take that long to spend that much if you are a medium-sized business, then you run out of that limit, and it starts to actually phase out. So there is a point that is not going to work. It also has the drawback that it cannot create a loss for your business. So if you have $100,000 of income on your business and $200,000 of Section 179, say you bought assets costing $200,000, you can't depreciate all of the $200,000 because your income's only $100,000. So the real limit in that case is not the 1,160,000, it's the $100,000. Okay, so you may, in that case, you may be frustrated with the idea of Section 179, you may be looking for another alternative to still take extra depreciation, not take it over the whole 5 or 7 years, but to take it all at once. And so you might move to bonus depreciation, which currently under current law, and this year 2023, it's 100%. 2024, it'll only be 80%, and it'll start to phase out after years after that. But right for 2023, if you pay for something, buy an asset, you can depreciate up to 100% of its cost. Again, you don't have to then calculate depreciation on that because use the tables or anything like that, because you're just going to take 100% depreciate on the whole thing. All right. That only applies to assets with useful life less than 20 years. So basically what you need to remember is bonus and Section 179, the last slide, do not apply to real estate. So if it's a real estate property, building of any sort, then you cannot use these special depreciations. You'll have to calculate it in the normal way using the useful life that was given in the earlier slides, okay? So the only, and this can create a loss. This bonus depreciation can be more than your income before depreciation. The only real limit is the luxury auto limit, so we'll talk about in the next couple of slides, okay? This means that most businesses are going to use the bonus depreciation, not Section 179, okay? Now, when we do the homework and stuff, we may tell you to use 179 or bonus or not, just so you can have some practice doing both situations. But in real life, right now, for 2023, you're almost always going to use the bonus depreciation on anything that other than real estate. Okay? And so we don't calculate regular depreciation very often in real life right now. Now, there is a definition of what's called listed property. And this applies to the property no matter what type of depreciation you plan to use. Bonus, Section 179, regular, okay? These are properties or assets that the IRS has determined are likely that you might use as personal assets as well as business assets. So they are suspicious that you might be overstating how much business use you might use them. Examples, autos and boats are listed property. Okay? So that's something that they think, well, if you had that as a business asset, you might be tempted to also use it for personal, or you might just be telling us that you're using it business when it's just a personal asset. Okay, so we're going to make you list these on the back page of the 4652. That's the form that you use to calculate depreciation. Turn that over, and there's a place to list these properties individually. And then we're going to limit, it's not a real serious limit, on how you take to calculate depreciation on these. We want you to give us more information about the assets, about how you use them and how much you use them. But if they're used less than 50% in the business, remember, if you use an asset even part of the time, you can depreciate the part that you use in business, even if it's 25%, for instance. But if it's less than 50% and it's a listed property, okay, you cannot do Section 179. And you have to use straight line instead of the regular tables. So there are some restrictions. Again, not overly serious restrictions, and they still only apply really if you use it for 50% or less. But you've given them information that makes it relatively simple for them to look at and compare to the actual documentation as to whether or not how much you've used that asset, and therefore they can disallow that depreciation deduction relatively easily on listed property. Now, even a narrower, if you take autos, a little narrower consideration is what we call the luxury automobile limitations. If the auto, regular passenger vehicle, less than 6,000 pounds, so most of your small SUVs, your regular cars, minivans, that sort of thing, are less than 6,000 pounds gross vehicle weight. So what the IRS was concerned about, and Congress was concerned about when they passed this, is that people would buy very, very expensive vehicles and then take very large depreciation deductions for them. So you buy a car for $250,000, and I've seen them, they exist, okay, they're out there, and claim it's a business asset and depreciate it. Your depreciation deduction could be very high using the normal regular depreciation, or very high if you use bonus, because you could depreciate the whole thing in one first year. Well, we said, no. We want a limit on that. If you're buying regular vehicles, less than 6,000 pounds, the most depreciation in a year you can do is $20,200. That's if you use bonus. And if you don't use bonus, it's only $12,200. The second year is $19,500, third year is $11,700, and then fourth year and after it's $69,600. Well, if you think about depreciation on a $200,000 vehicle, it would be close to $40,000 in the first year, according to the calculation of the table. So this is a severe limit on that compared to now. If your vehicle is costs you $40,000, then this is not much of a limit, right? Because even if you calculate the regular depreciation, it would be less than these limits, okay? So that applies, and if you depreciate, if it's very expensive, like $250,000, you're going to depreciate that in the first year's $19,500 in the second year, $11,700 in the third, and $69,600 for the fourth year, and every year after that for as long as you own that vehicle, because it's going to take a long time to depreciate. That's just about $7,000 a year. If it's an SUV or truck that's more than 6,000 pounds, if you use Section 179, it's limited to $28,900, not the limit we gave you in the earlier for just this type of asset. But the 100% bonus saves us and allows us to deduct the whole amount we paid for a SUV over 6,000 pounds. So still a very big benefit for buying a big vehicle. Okay, not much, you might say, encouraging small, light vehicles, right, in terms of that sort of thing. Gas-efficient vehicles. We're talking about basically a benefit for big vehicles. Typically thought that they would be American vehicles and that people would buy American cars and create American jobs, was kind of the rationale. All right, then the last kind of thing about depreciation is really not really depreciation, but it has the same kind of limit. What if we lease a vehicle? If we lease a very expensive vehicle, and that's very commonly the way people gain access to a very expensive auto, is they lease it. Well, do you get to deduct the whole lease payment, especially if it's a very expensive vehicle? And the same concern applies. That lease payment is way high and higher than it should necessary because you're paying for such a luxury vehicle. Maybe we should have a limit. So, but rather than technically a limit on the amount of the payment, they basically say, give a table that says, if the car was worth this amount and your lease payment is this amount, you have to not deduct part of the payment. So if your lease payment is $1,000, you go to the table and it says 5% is the inclusion, then 50 out of that $1,000 is not deductible. Okay? And they issue a revenue procedure each year with the updated for inflation numbers that tell you how to calculate the lease inclusion amount. Okay? Now, besides that, the percentage used in business would also need to be applied. So, for instance, if you bought a very expensive vehicle and your lease payment was $1,000 a month, and the lease inclusion amount was $100, so you only get to deduct $900, but you only use the vehicle 80% in business, then you would take that $900 deduction for the lease payment and multiply it by the 80%, right? Because the other 20% is not deductible at all, because it's personal use. So that percentage of use in a business always needs to be applied in any of these situations, from how we calculate depreciation to how we calculate the amount of lease inclusion and so forth. So the next slideshow is about other expenses other than depreciation. That kind of wraps up our depreciation. We have some examples, some additional examples in another video that kind of give you the idea of how they work together, the regular depreciation, the bonus, the Section 179, that you can watch and see that. All right, and then, but our part 3 of this will be other expenses that have some special rules that we need to know.